Unless you've been living under a rock, you've probably realized the stock market right now isn't doing great. Especially if you've just started investing the last couple of years, you're probably regretting your choices right now. With Trump going wild on tariffs and his new best friend Elon, there's a lot of uncertainty in the market right now, which stock markets really don't like. The S&P 500 in the last month is down 8.4%, which is a pretty sharp drop. And even someone like me who doesn't invest directly in the S&P 500, with a huge portion of the world index funds being made up with US shares, case in point 74% in one of my biggest holdings, the impact has been just as painful. In fact, in this last month, it's safe to say I've had a pretty bad month. In fact, it's probably the biggest loss I've had in my investing journey so far in a single month. Over £26,000. That's a full-time wage. I really wanted to show you this because it's all good and well showing a portfolio when it's going up, but we need to be real, and investing isn't like that. So I want to show the good along with the bad times. Transparency to me is super important. Now, I want to address what we do in this situation because I've had a flood of questions asking what I think about the market and is now a good time to invest or should you stop investing? So let's talk about what's going on, what you should do in this situation, and importantly, what I'm doing about it. So before we panic, let's zoom out a little bit and realize that market crashes are completely normal. If you're investing for decades like most of us will be, you should expect a few at least. The stock market doesn't just go up in a straight line, it moves in cycles. Here's how often market crashes happen if we look at the S&P 500. In the last 25 years, we've seen at least 4 major crashes. There was a dot-com bust, the 2008 financial crisis, COVID-19, and 2022's inflation crash. In the last 50 years, we've had 6 or 7 crashes. There we're adding in the 1973-74 oil crash and Black Monday in 1987. And in the last 100 years, roughly 15 to 20 crashes of 20% or more. On average, a crash happens every 5 to 6 years. So what's happening now? Nothing unusual, it's just another bump in the road. And the question is, how big of a crash is it? If you look at the biggest market crashes and what happened, there was Black Monday in 1987, which was the fastest one-day crash, where stocks tanked 22% in a single day, the worst one-day drop in history. It was a mix of panic selling and dodgy automated trading that spiraled out of control. The market fully recovered in just 2 years. If you had invested at the bottom, you would be up 5,000% today with dividends reinvested. Then we've got the 2008 financial crisis, the housing bubble disaster, where banks got greedy and they were handing out mortgages to pretty much anybody. The housing bubble burst, banks collapsed, and stocks crashed 57% from peak to trough. The market hit rock bottom in March 2009, and if you had invested at that low, you would be up 900% today, nearly a 10-times return. And even if you bought before the crash, you would still have more than tripled your money by 2024. And most recently, we had the COVID-19 crash, 2020, the fastest crash ever. The world shut down overnight and the market panicked. The S&P 500 dropped 34% in just over a month, one of the quickest crashes ever, which actually was followed by the fastest recovery in history within just 5 months. The market was back at all-time highs. If you'd bought at the March 2020 bottom, you'd have doubled your money in just under 2 years, which thankfully I did. These market downturns are a natural part of investing, occurring with different frequency and severity. They happen actually more often than you think. And then we have something called a minor correction, which is 5 to 9.9% drop. Now, on average, the S&P 500 experiences this decline approximately 4.6 times per year. A major correction is a 10 to 20% decline on average, and believe it or not, historically, the S&P 500 goes under a 10% correction about once per year. And in terms of actual bear markets, where the market declines 20% or more, well, since 1929, there have been 29 bear markets, averaging approximately one every 3.3 years. Now, every crash feels like a big one at the time, but history says otherwise. The market has always recovered, but only for those who stay invested. Crashes equal opportunity. Buying during fear has always led to massive long-term gains. So if you're feeling unsure about investing right now, just ask yourself this: will people still be buying stuff, using the internet, or needing companies to function? Will the world economy still exist in 10 years' time? And does every past market crash now look like a blip on a chart? If the answer is yes, then sit tight because history is on your side. So unfortunately, if you want to be part of investing on the stock market, this is something you're really going to have to get used to. But I actually, believe it or not, want the stock market to crash, which might sound a little bit crazy to say out loud, but let me explain. This is something I've been leaning more and more into recently. Now, a really good way to put it is a skiing analogy. So let's say today your share of an index fund is £100 per unit. And when you plan to retire in 25 years' time, that index fund is going to be worth £1,000 per unit. Take these with a pinch of salt, these numbers will vary. Now, if I showed you two paths, you've got path A. Now this is a nice green upward slope towards your end goal, a nice upward ski lift that just took you to where you wanted to be, and everything seemed nice and easy with little to no work. Or you've got path B, where you have to climb a slope, you may be taking a green or a black route down, some may be steeper than others, and then you have to climb back up again and do it over and over and over. Which one of these two would you rather pick? Now, on the surface of it, most of us would pick the nice, simple, easy option. Every time you look at your investing app, it's green and slowly going up. And you don't need to worry about any of these horrible times or scary slopes when the market looks down. But actually, is that the right option financially? Now, I'm not saying you need to believe in destiny and fate, but that index fund, when you're going to come to sell it, is going to be what it's going to be. You can't really control that future value. But what you can control is the price you pay for it now. Now, I'm not saying you need to try and time the market here because most of us will fail if we try to do that. But think of it like this. Let's fast forward to say halfway through your journey to make it a bit simpler. If the unit is currently costing £500 and you are going to sell for £1,000, would you rather buy it now for £500 or next week for £400? You want to buy it at cheaper points. Now let me show you how this works in real terms. So here's two examples. I've picked 10 random points on your investing journey from £100 to £1,000. Now path A looks like this. It's gone up in nice steady increments and your portfolio has been climbing nicely every year with no negative years. The second column shows how much you would have gained each year. Now let's add in the table from path B. This time we've assumed that the market has done a 20% crash every other year. Now if we add in the totals, you can see how much better path B has done. And if you were to scale this out across your investing journey, you'd be buying maybe 100 or 200 times over this period. So the results would vary, but the basic principle is the same. Each drop is another opportunity for you to buy at a cheaper price. And this is where you need to shift your mindset. Now it sounds funny, but investing is the only area where people hate sales. Imagine walking into your favorite store and seeing 30% off. You'd be excited to buy. Stocks work in the same way, that buying at lower prices mean higher returns in the future. Now, by no means do I think you should try and find these days, but with simple automated investing, you can take advantage of this dollar cost averaging, or pound cost averaging as it should be called here in the UK. This is really your investing superpower. If you want to set this up quickly and easily, I would highly recommend checking out the sponsor of today's video, XTB, who offer really great investing plans which help you set up averaging really easily. You can select your investments, set certain percentages into each, and set up a recurring payment to go into each of them. They have over 1,300 funds and 3,000 stocks, and they charge zero commission as long as you're trading under €100,000 per month. Their new flexible ISA is really great, allowing you to easily take money in and out without it affecting your allowance too. It's a really easy to use platform and you can earn up to 4.5% on uninvested cash, which is a huge offer. They're currently even boosting it to 6.5% in the flexible ISAs for the first 90 days, which is available to new and existing customers who open or hold an ISA account with them between the 1st of March and April 30th, 2025. Now, even if you know that market recover, it doesn't emotionally make it easier when you see the big loss on screen. And that's because of something called loss aversion bias. Studies show that losing money hurts twice as much as making money feels good. And this is why people panic sell. It's a psychological reaction and not a rational one. Essentially, your brain is working against you. When markets are going up, people get overconfident and they buy more. But when markets are going down, people hesitate, they don't buy, or they sell at a loss. But the best investors do the opposite. They invest more when prices are lower and they take profit when the markets are up. Now, of course, you don't need to take profits, but the principle of buying when it's lower is what you need to do. The best move that you can make is doing less. The worst thing you can do is check your portfolio every hour, and you should stick to a plan, zoom out, and remember your long-term goals. These are common mistakes that investors fall into when the markets crash. They panic sell at the bottom. A temporary loss only becomes permanent if you sell. If you're down 20%, you don't need a 20% gain to recover, you need 25%. If you're down 50%, you need 100% back just to break even, which is why at times it can feel hopeless. You need to remember that the market has always recovered historically, but only if you stay invested. The worst thing you could do is think, this investing thing just isn't working, and quit. Pause until you think things look better again. The best days in the stock market always happen right after the worst ones, which most people miss out on. And data shows that statistically that if you miss just the 10 best days of the stock market over a decade, your returns half, which is the last thing you want to do. So instead of guessing, stay in the game and let time do the work. You really need to avoid over-focusing on the news, because the media will always profit from fear and not facts. You'll always hear this time is different or the markets will never recover. Spoiler, they always do. So predicting a crash or recovery is completely normal. Most of the time it's just noise that you do not need to listen to. But the one thing I do really notice now more than ever is people just aren't being diversified. If you're too heavy in one stock or sector or one country, you'll feel the market drops more. In particular, people tend to be less diversified when something's done well, which is very easy to do even myself. When I've seen the S&P 500 rise, you think, well, why don't I just go all in on the S&P 500? I recently saw one investor put £100,000 just into the S&P 500 right as the market started to sink. So thankfully he sold and he did rethink his decision quickly. But remember that the faster they rise, the harder they can fall. Just imagine how a tech ETF is faring right now. The Vanguard Tech ETF is down 5% more than the S&P 500. So having a diversified portfolio spreads risk out, and remember at times other markets will outperform the S&P 500, even if it feels like the S&P 500 is the only thing that exists. Now, I really want to show you this because honestly, it does get easier, and it's why I'm actually not fussed about being down £26,000 this month, which might seem crazy. As much as that might make me think, well, what's the point of me working today when I'm down this much? It's just something you have to fight against, and over time it does get easier. So here is my Vanguard portfolio, and when I started this series of going from 0 to 100k on my YouTube channel, which I documented, it was actually a really bad point to start investing. The market sucked, and putting it kindly, if we look back at my historical performance down here, you can see here for the first 9 months I was investing, I actually made no money. It was only up from month 9 onwards. And then if we look more recently, you can see from here where it really started to accumulate. Now, what's nice when you get to this stage is you can see even though I had big losses of nearly £7,000 and £4,000, they just go into my total returns. I'm still technically down, but I'm still up £24,000 and £17,000, which is huge. And look at the big months I've also had back here. And this is where I really love this chart in particular, which shows the growth of my portfolio over time. You can see where I've started investing and how the portfolio has grown. Because over time, I've continued to add money at times when my portfolio might have dipped. It's just continued to grow and grow. And yeah, I've got this dip here, but eventually when I zoom out 10 or 20 more years, this huge dip that seems scary will just look like small dips back then, and you'll barely even notice them. What you have to do sometimes is remind yourself that sure, the market is down now and the 1 month view looks scary, but when you go back to the 5-year returns or the all-time returns, these investments have performed incredibly. Of course, that doesn't guarantee future performance, but it's important to know things do go up over time. At least that's what we're aiming for. I also want to make a side note here to say, well, if you don't want to time the market, if you feel unsure, keeping some money in your accounts getting nearly 5% interest isn't really all that bad, especially at this time of year. If you've got a lump sum to invest at the end of the tax year, which I currently have, you can invest it, hold some in cash, and then slowly drip feed it in. But statistically, time in the market does beat time in the market, but it definitely makes you feel a bit better. And if I'd have lumped that in 1 month ago, I'd be down 10% on it now already. So take this drop with a pinch of salt, stay the course, and you'll easily get through this. If you want to know more about how I actually got to this point, check out this video right here, which shows you how I built my portfolio and some of the challenges I faced along the way, and I'll catch you over there.